So my skip does not like it if I pull out my cell phone on the day.
But she's going to show us how to pull together some of the data effectively.
Okay, so
Thank you.
yes, hello everybody. Lots of places to get data. There is no shortage of data in the world. So I'm just going to show you what you've probably heard of and you probably know Mergent, but show you a little bit more advanced stuff in Mergent. Every time you do it, it looks different. So patients would be a click here, and then oh yeah, that's where you click. One thing I do know is it's available on the library homepage. That's the only way to get to it. This is a resource that you'll be using in your professional life, whether they actually call it Mergent or not. They have in the corporate world, they have a different branded name, and they're always different. So even if you don't recognize it, it's probably going to be Mergent data, so you're getting used to it. Subject guides, business administration, you know the drill. This is where you go to get all that stuff that we paid for, so you don't have to. Scroll down to the company information. This is where we have all the big stuff. So Mergent Online is the big one. Probably heard of Mergent Intellect. That might be going away, so ignore that one. We moved Mergent Online up front. That's the biggie. Our single most expensive database, worth more than my car, so definitely use it. And it's worth every penny. So what you want to do is start off by searching for whatever your main company is. And I know for you it's Goldman Sachs. Also best to search by ticker, because if you start typing in Goldman Sachs, you'll see there's a whole bunch of them. There's different trusts, there's different parts of Goldman Sachs. So what you really want is the big one. And that's going to be the one that's publicly traded. So search for it by the ticker, which is GS. First hint. Click on that one, and then here you go. Everything you need to know. It's good to be the key executive. Salary of $2 million. We click on that, we'll see what the actual compensation is. But what we really want to look at are the company financials. That tab over here. So, hints about this. Here's a lot of data. We've got lots of different options. You can look specifically at the balance sheet, at the income statement, the retained earnings, or cash flows, or what I do is I just click on all sections because I can never remember which data point is in which thing. So refresh and you will get all the data in one spot. You can also look at annuals or by quarter. So that's an important thing you want to do. And it defaults to 5 years by quarter, or you can look at 15 years available, which will get you back to 2002. Or you can do all available years. For very old companies like this one is, incorporated in 1989, not that old, but you'll get 1989 to the present. So that's an important thing you'll want to know. It doesn't default to that. That's how you want to do that. And then you can download it. Simple enough. Or this is the other thing that you probably have not played with. If you go over to the competitors tab, you'll see all who they consider the competitors. And there's a lot more here than you need. What you can do to get all of the data from all of these different companies in one place is to pick the ones you want, or delete the ones you don't want. So we don't want Morgan Stanley, we don't want Bank of New York Mellon. Let's just get rid of a lot of these. X amount. You want Citigroup, you want JP Morgan, you want Wells Fargo. Just type in their name, pick the one that has the ticker, add it to the group. Bank of America, BAC. This is one you'll want the ticker for because I typed in Bank of America, it was not finding it. BAC, add, and JP Morgan Chase, my bank. Add. There you go. So there you've got your 5. You've got all of your stuff right there. And then if you go up to that, or add all companies to analysis list, you've got them in there. And here they are. So then you can choose company financials. Say you want to report all those, and this will export them all into the same spot. So this is how you can do it pretty quickly, and this is how the pros get all that stuff into one data sheet really fast. You will want to move all of these over. So multiple full company report, that's what you want. And you can do the preliminaries or as reported. Prelims is not bad. Annuals, however long you want, 15 years. And then you can say which things you want. And you'll want all of these. Why not? And you want it in years, all the years that you want available, and so on. So this won't be a complete report because it'll take a long time. Move that over, and then there you go. Oops. You can make it in different ways. Always go with Excel. That's the easiest one that you can then manipulate yourself. And it is, can't see on that screen, but it is thinking. And then eventually we will get a very large spreadsheet. I probably made it too large, so it's going to take a while. So this is the first stop. You can get this data at lots of other places, but this is the way that you can professionally manipulate it and export just the parts you want, go back. It's like all research. Sometimes you get it right. Sometimes you're like, oh, that's not, I didn't want that piece. So go back, either delete it or go back and run the report again and take stuff out. There we go. And it is now there. So even if you didn't remember the steps, remember that it's possible. That's the big thing.
Spreadsheet?
Yep, it's opening.
Okay.
Or trying to open, it is a big one. So even if you don't remember it is possible. Any of the librarians here can help walk you through that steps. They'll probably go, I'm not sure, yeah, let's click here, let's try this. But we will be able to figure it out eventually. It's one thing about our profession. So we don't always know it, but we'll try to figure it out. Okay. It is a big one, I made it too big. Okay. So it automatically will always throw in this stuff, copy and delete, or select and delete if you don't want the whole business summary and all the charts. But when you scroll down a little bit, there you go. Then you start to get the good stuff. So yeah, I clicked the wrong thing and it included everything. So here comes the, somewhere down here is the actual data.
And where's the, how do you read the time series?
The time series.
You know, like the earnings per share, and how would I find earnings per share for gold?
You can always do it command find in the spreadsheet, but what I have discovered also, let's go back to the company financials. Again, I always go to all sections because I never remember which one it is. Command find, earnings, and then you go down to where it is. So earnings loss, earnings per share basic, and then deleted. So,
yeah, and then where's the data that goes back as far as you can?
this is defaulting to annually last 5 years. So pick years, quarters, last 15 years, refresh, and you'll get longer. So there it goes back 15. You can do all years available. You'll get all the years that are available, which for things like US Steel go back to like 1899. This one only goes back to 1997. That's when they were incorporated, or at least this particular branch of the company was incorporated. So that's where you get it. You can, what I often do instead of making the full report is I go to each one individually, export it, and then merge them myself, but I'll leave that to your own personal technical abilities and desires. It is all available to do, but here is that data. So let's see. Earnings per share, there's the earnings per share for the last 15 years.
Is that last one 2017 or 2016?
Let's take a look.
The very last one.
16.
Okay.
Should be the last report.
Okay, can we go all the way back down so that I can use it? Thank you.
There we go. Nope. Great.
So that's just the income statement?
Yeah. So there it is, 1653. That's the most recent. And it was a loss, whatever year that was. So 16, 15, 14, 13, 12, 11, 10, 9, 8. Oh, that would make sense. 2008. It was a loss. So there you go. There's data. I'll leave this window open so you can mess around with it later. But while I'm here, it's great that you've already played around with Standard & Poor's, also a very big name, super can't exist in the world without Standard & Poor's. And IBIS World and all those amazing things. We also newly added as of February, we had one source which then got bought by D&B Hoovers or Dun & Bradstreet, another big name that you will hear. So we do have access to this data as well, which is pretty amazing. The financials are obviously the same because they're the financials that are reported by the company, but there's other, amazing stuff included here. Why I always like to mention it, is this is also good for international companies. So it has a lot more on international companies and private companies. So here you go there. There's more stuff. The financials will be the same. You'll see other things, other analysis kinds of things that they do. So you can actually see the side. So they have signals, news, closest peers. Some of these, this one doesn't, but some of them have SWOT analysis or analyses. So their analysts have already done strengths, weaknesses, opportunities, and threats. So every company's going to be a little bit different, but this is also a good source to remember. So D&B Hoovers, going to be your friend. Mergent Online, definitely a friend. Other name for Mergent is Moody's. Sometimes you'll be able to throw those names around interchangeably and people will know what you're talking about. So these are the guys who put their entire careers on the line for having correct data, so go with them. The other thing here are, where I think I showed you the ratios, so there's the ratios there for the individual company, all years available, annuals, quarters, you got it, all here. But it's important to know that there are multiple tabs up here, and then there are the things underneath the tabs as well. So any of the librarians can help you with this. Best bet, know the ticker of the company you're looking up. That'll make sure you're getting to the right one. When you have the opportunity in the company financials, balance sheet, income statement, you can go to all sections. That helps. Is that in cash flow? Is it an income statement? I can't remember. Select them all and it'll show all of them in one spot. Make sure you're looking at the right time series that you want. And then the Mergent tools and the download are also going to be your more advanced friends. So that's pretty much it. Mergent in a nutshell. Super, super powerful. So it can be as much or as little as you want.
Can you take us back to the EPS so I can put those up? That's for since 97.
I'll go back to that. For sure. There we go.
Okay, perfect.
All right. So if you have any questions, holler at us. That's what we're here for. I won't be around this weekend, so if there's anything comes up this weekend, just go to the reference desk, and whoever's here will help you with that. I'll give them a heads up that you may be coming or may have questions, but then I'll be back Monday. So don't stall, wait for me, go for them first, and then I can help out if they get stuff.
Thanks, Sarah.
All right.
Thank you.
You went a little while.
Huh?
Do you need me to move?
No, you're cool. So after today, I'll upload a video. Deliverable 2 is today, so make sure you have the cover and the flip, the memos, the midterm, the homework, the movie review, and the resume quiz. Then the final class schedule, Tuesday, Thursday. This week we'll do the chapters, 18 and 19. The Goldman Sachs valuation, I've already started the valuation methodology. If you can maybe find me the value of the debt, the value of the equity, we can put that up there. If you can find me a beta or some betas, that would be great. And then I already have the earnings per share, so then we can walk through how to determine the discount rates, how to value the company, and then get you started on the valuation, and then we'll do the financial ratio analysis on Thursday. And that should get you set up for next Thursday. Okay. We already went through the merging stuff. You've already received the value line, Net Advantage, Morningstar. I'd also use the company website, and I'll send you the merge in Excel spreadsheet. Okay, so you have that available to you. And then next week, Tuesday, Thursday, we'll continue with the training, wrap that up. Hand in the first draft on Thursday so I can start seeing it, but you can start showing me the draft as soon as possible. The leaders should have examples of the pitch books, and I have some extras over there if you want to grab some, take some pictures. So you have basically an inventory of final product. And then we'll do chapter 20 and 21 next week. And then Tuesday, Thursday, May 16th and 18th, you'll come in professional dress and make your presentations on Goldman Sachs. Also, bring me the draft printed out, 1 slide per page, black and white, stapled in the upper left-hand corner so I can edit. You can bring the presentation to me, I will make edits on it. During the presentation, I will make edits on it. And then the final week, we can finalize the edits and make sure when you go to production that the product is. And then on the final day, on the 25th, I'll do an integrative review of the course and do an exit lecture. Hopefully that won't take more than an hour and a half. And then deliverable 3 will be cover clipped. The memos, take-home final, it's only going to be 2 problems. We already worked through them. Goldman Sachs presentation, and again, final draft, color, bounded, boom, and then the resume. So is everybody clear on what we're doing over the next few weeks? Okay. I'm going to go through just a quick overview of the Goldman Sachs analysis, then I'll get into the business valuation, then we'll start on the valuation. How am I doing on time?
10 hours, 5.
Okay, perfect. So the Goldman Sachs valuation, we pulled some data, provided you with the research reports, provided you with the templates. Is everybody in a group? Yep. Everybody knows their roles? Okay, perfect. And then the financial ratio analysis we'll do on Thursday. This is a little tricky. And then the methodologies, what we'll do today is we'll go through discount rate determination, put together the earnings per share time series. Then we'll do the valuation methods. I'll do technical analysis later because that's the first in the valuation series. And then we'll go through perpetuity, Gordon growth, the multiple approach, and the discounted cash flow. And we'll need multiples in the multiple approach. We're going to need the multiples for the peer group. And we're going to need 2016. And then you're going to need to estimate 2017 and 2018 for the peer group. Okay. And that's just basically a table. And then we'll do the discounted cash flow. So we're going to have to come up with some forecasts on the earnings per share. We'll do scenario analysis at the end. We'll do the trade recommendations, and then references will be the last slide in the pitch book. Okay, and I've already put together 12 references for you. And we got Mergent. Some people use Google Finance and or Yahoo, but be careful with Yahoo; they do make mistakes. NASDAQ Research, Value Line, Standard & Poor's, Morningstar for the companies. Standard & Poor's and IBIZ also provide you with the industry research reports that I gave you. Obviously, Goldman Sachs company website, that's probably one of the best sources. And then stock charts and big charts. You can get the stock charts going back 2 years with the MACDs and the MSCIs, the momentum indexes and the charts, so you can do the technical analysis, on the company. And then, Dun & Bradstreet numbers, which I've never really used, but that's there too. The more references you put in on the page, the better, and good references, knowing that the data, is high quality. The only thing that's probably of low quality is really Yahoo Finance. It's really easy to get to, but the quality's not there. They just calculate the stuff, and I don't think they do much quality control. Okay, any questions on that? No? Okay, so let's do chapter 18. This is on business valuation. So when you're evaluating a firm, you want to look at the organizational structure, what type of firm it is. You want to look at the marketing plan. If it's a startup company, this is going to be the key document in which you go out and raise the capital. The valuation you can use for established firms, the earnings per share. For public and private companies, you can use the multiple approach. And then startup companies, you'll probably use the multiple approach and or maybe the discounted cash flow. When you're looking at companies, you want to figure out what the motivation was of the startup, of the company. Was there a need? Was there a problem? Was it money? For market opportunities, where the founders were motivated to go into the marketplace? Are you starting up a company, or are you buying an established company? Again, the valuations are all critical in both those situations. And then you have to look at the product or service that you're selling. What's the market you're selling into and the segments? What's your strategy? What's your financing? What are the assets that you need, and what's the people talent that you're going to need? You're going to need all that stuff, technology and people. Most companies fail due to lack of acceptance of their products, lack of management capabilities to be able to run a startup company or actually run the company. They run out of money. They don't have the knowledge to build the company when it starts to accelerate, or they just don't know how to manage the company, particularly startups. They burn through the money too fast. So they just don't have the skills or the experience. They lack a business plan and they can't execute on it. They don't have clearly defined milestones, goals, and objectives. They don't meet them, they're delayed, they fail. There's different forms that you can set up for your companies. You can do an LLC, which is the easiest, which I would recommend. I wouldn't do a sole proprietorship. You can do an S Corp, and if you do a C Corporation, that's the most bulletproof. You set up the board of directors, you set up corporate governance, and there's a lot of flexibility in the corporate structure. It just costs more, but again, if you ever build that company and you want to sell it, it's easier to sell a C Corp than an LLC or an S. If you want to set up your own company, C, an S, or an L, you can hire an attorney to do it, or you can go to LegalZoom.com. I've set up LLCs, S's, C Corps under LegalZoom. It's pretty cheap, it's easy, and you can set those up pretty quickly. And then you got to run the company, obviously. When you're valuing the firm, you got to come up with financial projections, particularly cash flow projections, for at least a 3 to 5 year period, either on a quarterly basis or an annual basis. Because they're going to want to know when they review, because you're going to have to go out and get the money unless you're rich to fund your own company. You're probably going to have to go out and finance, raise capital, because they're going to want to see the business plan and they want to see the financial projections. They're going to want to know about break even, positive NPV, PV, and they're also going to want to know the burn rate. How fast are you burning through the capital that you currently put in the company or that you raised? Because if you burn through the capital too quickly and you got to go back into the marketplace to raise another round of capital, it becomes harder and harder unless your business model is taking off and you're generating revenue. So it's almost impossible to do a second and a third round if you're not generating revenue. You got to put together the marketing document, the business plan, the pitch book, what you're doing right here. You got to be able to, in the pitch book, you got to be able to tell the founder's story or the key personnel story. Who are these people? What's their background? What's their experience? What's the product that you've, or the mousetrap that you've built? How are you going to sell into the market? What's the product adoption cycle? What's the intellectual property that you're developing and the value of the intangible assets? You have to be able to show the revenue curve, the adoption cycle, put that into a spreadsheet, discount that back to show the IRR and the NPV and the PV and the break even. Because they're gonna scour through your business plan, they're gonna scour through your financials. They're gonna do an underwriting and an audit of everything. And then you gotta be able to ask for the capital. You gotta be able to pitch and ask for the money and be compelling enough to where you capture enough of their interest to be able to then give you the money, okay? And they'll still be skeptical. And you'll probably have to give up a portion of the company and maybe control the company at some point in time. Because they'll probably either push you out or kick you out if you don't have the capabilities to run the company. And then in the appendix, you're gonna have all the backup information, which is usually the pro formas, the cash flows, the budget. Can you turn the, I'm getting good. Can you make sure that it,
Hey,
the
can
whole
you
wall's
shut
there
that?
too? Thank you so much.
That's good. Yeah,
Is everything up there?
yeah, you're good.
Okay, thank you. Okay, so when valuing these companies, you gotta put them in an economic context. Where are we currently in the business cycle? It's almost impossible to value a company and to sell a company and to start a company in a recession. Pretty much impossible, unless you're selling ice cream or insurance or something that's counter-cyclical. You gotta look at interest rates and where we are in the interest rate cycle, because obviously that's gonna determine the cost of the equity, the cost of the debt at some point in time. The venture capitalists are obviously gonna be looking at the yield curve, and anybody else who's lending you money is gonna ask you, well, why would I invest in your company when I can get 5% or 10% someplace else? So it's gonna affect the cost of the equity, the debt. Maybe later on you're gonna do loans, maybe you're gonna issue notes. It's all gonna be affected, okay, depending on what the economic environment is. The first three approaches, the value of a firm, is the cost approach. How much would it cost to basically replicate the firm, to rebuild it? The market approach, which is have other companies like ours been bought in the public markets before, or we can find the multiples and then slap the multiples onto our projected cash flows to get the valuation through the market approach. And then the income approach is the discounted cash flow approach. So the cost approach is really just the replacement. How much is it going to cost for me to replace the company, net of any costs? So you have to be able to replace and duplicate on an individual basis the individual assets. So you do it the replacement method on the individual assets, and then you roll that up to the enterprise level. Okay? You have to make the decision, do I buy or build it? Is it cheaper for me to buy the company than to build it, or is it cheaper for me to build it than to buy it? Am I gonna have to pay a premium or a discount when I buy or build the company? And then you have to include also intangibles, goodwill, and intellectual property. Do they have trademarks and patents that have value within the company that we're looking to value? You have to look at the personnel and the quality of the skill sets, and the education levels, and the people that work for the company and how they work together as a culture will also impact value. And then the timing of the cash flows. How does the money come in? Daily, weekly, monthly, quarterly, how does it work? So the adjusted book value is the floor of the valuations. It's the fair market value for a holding company that has different operations within the company. So you're gonna have to value the assets, and you're gonna have to determine the cash flows for the individual assets. Sum them up, total value of the firm. The next method is going concern. Okay, when you're evaluating a company that you think will last forever or go on for decades, then you would use the multiple approach. Got the cash flows, forecast it out, slap a multiple, get the value on it, because the multiple assumes that the cash flows are going to last forever. The market approach, there's two types. There's multiple analysis and transactions analysis. And then the multiple analysis, again, you can determine the multiples through the calculations. If you know the value, you know the cash flow, project it out, you can get the value of the firm, or the multiple for the firm. Obviously, the multiple times the cash flow is going to give you the value. You can do the value divided by the EBITDA, or EBIT, or earnings, depending on what you're trying to measure to get the multiple. You can do the stock price divided by the earnings per share to get the multiple times the earnings per share projected. You can do the stock price divided by the EBITDA per share to get a multiple. And you can also look at multiples of other publicly traded companies to get multiples. You can do 1 divided by I, 1 divided by I minus G to get multiples. So there's multiple approaches to value. The transaction approach is you go into the marketplace. This is where the venture capitalists and the investment bankers have a comparative advantage because they know where to get the deals that have just gone down, or they've done the deals themselves. So they know what the sales price is, and they know what the cash flow is. So they can come up with a multiple using the transaction approach, using actual transactions. And these transactions can be found in financial statements of public companies that have to announce and they have to report the acquisition of those companies. So public financial statements, particularly the footnotes, is a great place to get the information. The problem is these transactions aren't consistent, and we don't really know the total deal, the provisions, the deal terms that affect the multiple and the valuation at the end of the day. The income approach, which you all know, determining the net present value and present value, the internal rate of return, the break even. Again, it's difficult to estimate the life of the company. That's why you use usually a 5 or a 10-year projected cash flow statement, a pro forma, and then you calculate the terminal value. The terminal value basically encaptures perpetuity into the valuation. So the value of the firm, as you know, is the present value of the free cash flows from operation, the present value of the terminal value from the operations, and then you have to add in the present value of the free cash flows from non-operating entities, maybe royalties and patents and all those things. And then the present value of the terminal value for the non-operating entity to get the total value of the firm. Again, the value of the firm can be the projected cash flows into the future is discounted back to the present to get the present value. And again, you want to use net free cash flows. You want to take out the expenses. And you also want to take out short-term liabilities, because those really don't affect anything. You're really looking for long-term liabilities when you get the net cash flows. So when you build your cash flow statement, it's going to be revenue projections, operating expenses, EBITDA minus depreciation amortization. It's going to give you operating profit, or EBIT, times 1 minus the tax rate. It's going to give you net operating profit. Add back depreciation amortization. You're going to get cash flow from operations. You take out CapEx. You take out additions to working capital, and you get the free cash flows. And that's what you're going to use to value the firm at some discount. If you're looking at equity, trying to determine equity, return on your equity or equity cash flows, you got to take out the debt payments, and you got to add any debt issuance that you issue to get the equity cash flows. And then you can rerun. What you usually want to do is you want to run the IRR on the free cash flows, and you want to run the IRR on the equity cash flows to get the return on equity. And this is what the investors really want to look at, because this is the money that they're getting. This is the return. You can also value the equity by using the dividend discount model. If you think the dividends are going to be flat forever, you just divide it by the equity cost of capital. If you think the dividends are going to grow at a constant rate forever, use the Gordon growth model. Or you can go ahead and do the dividends out as far as you can, or with the terminal value, and do the discounted cash flow approach. So you can do it that way too. Perry, can you?
Yep.
Any questions so far? And then you don't have to have that whole part, just this section right here.
Okay, and then turn it.
Yeah, you don't have to do it all the way. And then do the, we'll do that in a minute.
Okay, sounds good.
Okay. So I did some examples of some valuations. So we have five-sided company. We have $230 million in debt. We have net income of $121 million. There's a comparable company out there that's similar to theirs, New Con. It's an all-equity firm. We have 150 million shares outstanding. The current stock price is $14.25. We have net income of $182 million. So we're trying to figure out the total value of the firm for five-sided. So the first is to get the PE multiple. So we know the price of the shares for the competitor. We know the number of shares outstanding, so we can get the total equity. We know the net income, so we can divide the total equity by the net income to get the multiple. So we come up with 11.74. Then if we can take the multiple and multiply it by the net income, which we know is 121 million, we can get 1,420,000,000 for the value of the equity. Then we just have to add the value of the debt to the value of the equity, and we get $1.65 billion for the value of the firm. Okay, any questions on that? Okay, so the next one is we have Serville. We know that the EBIT is at $247 million. Depreciation amortization is $84 million. There's 135 million shares outstanding, and the current share price is $12.80. There's a competing firm out there where we were able to find an EBITDA multiple of 5.4%. So to get the free cash flow, we can take the EBIT plus the depreciation amortization, and we get 331 million times the 5.4 multiple. We get the total value of the firm, $1.79 billion. So fairly straightforward on that one. And then example 3, you have Protos Zeiss. I don't know where to get these names. The assumption is there's rapid growth for 4 years, and then the cash flows are going to flatten after that. So we don't need to do a terminal value for this one. So the free cash flow, and we know that the weighted average cost of capital is 10%. So they already provided us with the 4 years of the free cash flows. So we can figure out the present value of the free cash flows over the 4 years. Then they took the cash flow in the last year, divided it by the cost of capital to get the terminal value. We also had the valuation of the non-operating assets at $23.4 million. So you have the present value of the cash flows plus the terminal value plus the non-operating asset values, and we get a total enterprise value of $864.31 million for the company. Any questions on that one? No? Okay. And then example 4, we want to get the value of the equity. So Simplitar company, it's going to grow rapidly in 3 years, no growth after year 4, no non-operating assets. The WACC is 12% and the debt's $44.5 million. So they gave us the free cash flows, and the present value of those cash flows over the 3-year period is $29.8 million. We took the last year's cash flow, divided it by the WACC to get the terminal value, discounted that by 1.12 to the third power to get the present value, which came out to be $104.99 million. And that's all we have to do is add the present value of the cash flows, plus the present value of the terminal value. There's no non-operating assets. So the value of the firm is $134,800,000. So we take that and we subtract out the debt, $44.5 million, we get the total value of the equity of $90,300,000. Okay, all right. So ready to do Goldman Sachs? Okay, can you find me the beta, risk-free rate, the value of the debt, the value of the equity? You should be in your reports. When I pull up the earnings per share stuff, so maybe you can find that data for me, please. And Harry, is that on the, is that down on the calculation?
This last one. Yup. It's all good.
Can you find me some value of the debt and the equity? Don't use short-term debt, just use long-term bonds. And then the value of the equity. So it should be either in value line, Morningstar, S&P, Virgin, or you can go to the annual report and get me the 2016 annual report and use those numbers that were audited by, I'm sure, a couple auditing firms will give you those numbers too. And while you guys are looking, can somebody read off the earnings per share up there? Going back in time, so I can fill in the time series with the earnings per share because we're going to need that. How much time do I have? How much? Okay. So can you, would you read me off the earnings per share going back in time? Are you going to do that?
Yeah.
Okay, awesome. So 2016 was 1653.
Okay, so then, 1235.
In 2015.
Oh, yeah, $12.35.
Oh, thank you. Okay. And then can somebody start calculating the percentage changes here? Go ahead.
$17.55,
Okay.
$16.34, $14.63,
Great.
$4.71,
Okay.
$14.15,
Okay.
$23.74,
Got it.
negative $2.15,
Thank you.
$4.67,
Got it.
$26.34,
Got it.
$20.93,
Got it.
$11.73,
Got it.
$9.30,
Got it.
$6.15,
Got it.
$4.27,
Got it.
$4.53.
Do you actually go back further than that?
$6.33, $5.69. And that's as far as it goes.
So I went back here because that was the peak too. Okay. Because I want to get growth in earnings per share over the business cycle. Right? Are we in growth peak or are we in decline recession right now? Are we in growth peak in the business cycle or decline recession?
Growth peak.
Growth peak. Okay. So you want to go back in time and look at the growth peak phases of the business cycle to get an idea of what the earnings per share growth rates could be in the projection period. Okay. So can somebody give me the percentage changes? Can you calculate the percentage changes here? And just do the positive ones. I don't need the negatives. Most of these are going to get taken out because we're in a recession. We're not in a recession. So can you give me, obviously we can't do this, but so can you give me the percentage changes? And I would probably start building your spreadsheets based on this. Because you may have a different view of what the growth rate projections are gonna be going out than me, right? Or you could just take my numbers and put it in the PowerPoint presentation, but that's not really doing anything, right? So can you give me the percentage change here? Okay, hello, everybody, anybody home? I got like 32 analysts in here and I got nothing. Can you calculate the percentage change here for me?
What is it? It's old minus new divided by old, right?
Percentage change. Is it? Really? Is it?
New minus old.
Thank you.
Divided
By old, okay. Or what you can do is just take this divided by that, okay? Minus 1 times 100, which is minus 1, it's gonna be 1 point something, 1.0 something. That's how I do it, so it's easy, you can almost do it in your head. And can you pull out your calculators, please? And start running, we're gonna run out of time. Just do 6.33 divided by 5.69, what do you get? You should get like 1.0 something. 1.11, so it's basically 11%. You want to know how to do it quickly. Okay. And then what's 6.15 divided by 4.27? 44. And then what's 9.3 divided by 6.15? 51. Okay. And then what's 1173 divided by 9.3? Does everybody understand what I'm doing?
Mhm.
It's easy to do it this way. Instead of doing new minus old divided by old, I mean just divide it and it's 1 point something. Okay. So what's 20.93 divided by 11.73?
1.28.
It's 28.
I didn't get that. I got 78.
78? Really?
What you want to see it, bro?
No. Well, what was happening in 2004 and 5? We were coming out of a recession. So the earnings per share is going to grow really quickly in those recovery periods because they just got pounded. What's 26.34 divided by 20.93?
1.258.
What is it?
1.258. So what is that, like 26?
Yeah, just give me the numbers. And then that's negative, and then that's going to be a crazy number, right? That's a crazy number. That's a crazy number. This is going to be ridiculous. So it's 14.63 divided by 4 points, like, so it's like 200 and something. Yeah, 210%. So what's 16.34 divided by 14.63? What is it?
So 12.
12%. 17.55 divided by 16.34. Okay. And then this is a negative, right? And then what's this?
34%.
So can you average this for me? Because this period right here is where they got sued. And they had to pay billions of dollars in lawsuits. So they took it out of the earnings. So this is basically an artificial number. Can you just give me kind of a straight line on that? Just an average of the two? Now we're starting to manipulate the numbers. Okay. So what's 17.5 plus 12.35 divided by 2? What is it? 14.95. And what's 16.53 divided by 14.95? 11%. So how many of these can we actually use? We can use this one. Okay. We can use this one. Maybe these. basically you just go back in time. This was basically recovery peak. This is recovery, so that's the high. This is basically recovery, and this is basically peak. So in the growth peak phase of the business cycle, it looks like the growth rates in the earnings per share are between 11 and 12%. So we can use that 11 and 12%. So the question is, what do you think the earnings per share growth rate's going to be for 2017? And we're not going into a recession. So what do you think the growth rate should be? Just based off of historical analysis. I mean, they missed, when you read about the company, they missed their fixed income trading revenue, which hit their stock, but it's an extremely profitable company. It's one of the top picks in the sectors. So what do you think the growth rate on the earnings per share will be for 2017? Is it going to be negative?
No,
Is it going to be 25%?
no, it'll probably be around like that 12, right?
Yeah, it's probably going to be around 12. I mean, doesn't that make sense?
Mm-hmm.
Yeah, it totally makes sense. And through your analysis, you can figure out, you'll be able to justify the 12%. But let's just use 12%. So, what does the outlook look like going out over the next 5 years in regards to the economy? So, employment growth is falling, CPI is negative, profit margins are recovering at the corporate level, industrial production's up, GDP is forecast for 1.7, maybe 2 to 3% going forward for 2018. I don't think we're going into a recession. So what do you think the growth rate's going to be between 2017 and 18? You think it's going to be the same, less, or higher?
Higher.
You think it'll be higher? You think we'll get a resurgence through tax stimulus, through Trump's cutting of the taxes, the infrastructure spending, building of the wall, military buildup? I mean, those fiscal policies do have an impact. And then interest rates are probably forecast for next year on the 10-year treasury. Let's see, there's 2 interest rate hikes, supposedly, that are going to occur this year at 25 basis points each. Where's the 10-year treasury right now? We can factor in a forward interest rate scenario. Where's the 10-year treasury right now? Is it like 2.23 or something like that? The yield on the 10-year treasury? You're gonna just look, I mean, this is part of the lab, this is part of, what is it? It's 2.3. So where do you think the risk-free rate's gonna be next year? 2.3, add on 50 basis points. So that's 2.8, roughly 3%. Is that still relatively low? The 10-year treasury usually in the recovery peak phase averages 5%. So at 3%, that's 200 basis points below the long-term average, which means that monetary policy is still going to be accommodative over the next 2 years, at least. So are you going to be forecasting a recession? No. So what would the growth rate be for 2018 under that macro scenario? What's your feeling? And usually what I like to do is to get people's opinions so that I can get consensus on stuff, so that I get majority, and usually through consensus of the analysts that I work with, I can come up with the best inputs into the model, and actually 9 times out of 10, you're right. And I can't rely on one person because I know I'm going to be wrong. Okay? I need consensus from people. I need you to be engaged, and I need to get you need to give me your opinion.
We're not forecasting a recession.
I just listed all the factors why there wouldn't be a recession. Okay, so what do you? And we already know what the growth rates are based on prior growth peak periods. So if you're not forecasting a recession, then you use basically the sample and the current projection to be able to figure out what you think the growth rates and earnings per share is going to be over the holding period. You could probably even Google, go online, go to those sources, look at consensus estimates of earnings per share for 2018, although they're probably going to be wrong or underestimated because they're calculations, not based off consensus of analysts that are sitting in the room that are basically doing the research in real time, because those consensus estimates have a lagged effect in the information. Okay, so what do you think 18 is going to be? 13. Okay, you got 13, up to 12, 12, be careful, she might be wrong. 13,
13.
14,
17.
17, wow. 18, wow. Over here. Huh? 14, okay. 13, 15,
13.
13, 15.
22.
You're,
15.
there's no probability in that.
15.
15,
13.
13, 13,
16.
16, 14.
13.
Okay, it sounds like the average is like 14. Okay, so let's use 14. Even though employment's decelerating, maybe they have the ability to grow earnings, maybe they've written off all of their bad debt and other things that have been holding down their earnings, and maybe they even can beat analyst expectations because they've been holding on to some stuff. Do companies manage their earnings per share? Do companies manage their earnings per share? Do companies manage their earnings per share?
Yes.
Yes, they do. Okay. So they have little things that they can pull out at the last minute to beat analyst expectations, to drive the stock price up, because they did miss analyst expectations because their trading volume was missing in the last quarter. Okay. So what do you think about 2019? And remember, this is the 8th year of the recovery. Most recoveries only last 7, so we're 1 to 2 years past the average recovery period in the business cycle. And there's a 90% probability of a recession in the first 5 years of every single decade, based on my calculations. That's why I'm forecasting a recession for 21, 22, and 23. So that kind of gives you a macro view. So what do you think the growth rate will be in 2019 for earnings per share? Okay, and at 16, it's still higher, even though we're potentially going into a recession. What? 12? 12, 13, 13, 13, 13, 13,
11.
11, 11, 12, 12, 12.
11.
Okay, it looks like the consensus is good. Okay, what about 2020? Okay, I got 11, anybody else? What?
I think 10.
10? 10? 10? Because usually it's going to taper off, right, as you start to go in the decline. And who knows, maybe Trump's policies will create massive amounts of debt. You know, $6 trillion for additional monies to pay the tax cuts, plus probably another $4 trillion for all the stimulus, military infrastructure. That's going to double the debt, right? Take it from basically 20 trillion outstanding to 30 trillion outstanding. That's a lot of bonds, right? And if nobody buys those bonds, bond prices are going to go up. Down, interest rates are going to go up, and the economy will probably fall into a recession. The stimulus and multiplier effect on one side is going to be negated by higher interest rates. So what do you think for 2021? Okay, I got 8. 8. Anybody else? 8, 8. And what you can do too is if you build this into your model, into your spreadsheet, what you can do is you can go back and update these. If your valuations are really low compared to the current stock price, you're underestimating the growth rates. If your estimates are really high, you're overestimating the growth rates. So through this exercise, it actually tells you what the analysts are thinking in the marketplace. And then you have to reconcile the two. Okay? But I don't back in to the price per share currently, what I do is I run the analyses first, and then I go back and look at them and see where I might have made mistakes. But I don't try to reverse engineer the models to get to the current stock price. I want the models to stand on their own as an unbiased measure of the current value of the company. And what about 2022? Again, we could be entering into a significant decline phase or maybe even a recession. If based on my calculations are correct, we've experienced a recession in the first 5 years of every single decade going back 150 years in post-World War II. Post-World War II, we only had 2 recessions in the last 5 years of a decade, 1958 to 2008. So is it reoccurring? Yeah, I have multiple observations going back 150 years. So we just plan it. So what's the growth rate for EPS in 2020? 5? 5? Okay, and what about 2023? Because remember, we gotta take it out one more year to get the terminal value. 2? All right, we got it. So what's 1653 times 1.12? 18.51. What's 18.51 times 1.14?
21.11.
What is it?
21.11.
Okay, is this correct? Is everybody checking my numbers?
Yeah.
Okay. What's 21.11 times 1.12?
3.64.
What is it?
23.64.
Okay, and what's 23.64 times 1.1?
26 even.
Okay, and what's 26 even times 1.08? You guys building your spreadsheets?
28,
Putting in the data? What is it?
28.1.
28? Yeah. Okay. You guys want to start putting these into your spreadsheets, okay? Because would you want to do this by hand? No. Okay, and then what's 28.09 times 1.05?
29.49.
29.49. And what's 29.49 times 1.02?
30.08.
30.08. Got it. Okay. So do we have the cash flows we need to be able to do the analysis? Can we run all the valuations now? Okay. And then how much time do I have?
20 minutes.
Okay. Might not be able to get through everything. So for the perpetuity model, oh shit, I forgot to do the discount rates. Okay, what's the debt? Anybody look up the debt? On the balance sheet? Okay, what was the risk-free rate? What did we want to use? You guys can look up the debt and the equity, and what do we want to use for the risk-free rate? 2.4, 2.5? What do you want to use for the risk-free rate? Can somebody find me the beta?
1.57 is what I found
For what?
for the betas. 1.57.
Golden's pretty leveraged, and they take a lot of risk. I mean, 900 billion in assets. Their focus is investment banking. Is that risky?
Absolutely.
Yep. Derivatives trading, currency, interest rates, credit. They also use their balance sheet to take the other sides, those positions. They do other banking services. They don't hold deposits like the other banks. They have investment management, and they do private real estate equity, and they also do mortgage lending. They're very aggressive behavior, very aggressive with their in getting customers in the markets, going after and attacking regulation through lobbying. A lot of their people that lead Goldman Sachs go into government in major cabinet positions, and they're totally focused on return on equity. And they like to use leverage to do it. So what What was the average return on the S&P 500 over the last 15 to 20 years? Because we want to get the expected return on the market to do the CAPM, you get the cost of the equity using CAPM. So what's been the average rate of return annual on the S&P 500 over the last 15, 20 years? What was it? Is it 3%? Was it 3%? Okay, so basically the S&P 500 has returned exactly the same as the 30-year Treasury bond. You think so? Why would I buy stock when I can buy a 10-year Treasury? You're assuming no risk premium. So what's been the? Can't you even Google that? Could you Google the average return on the S&P 500 over the last 15, 20 years? You guys can get all the information now at your fingertips, okay? At your fingertips. You're the first generation to have everything handed to you via the computer. Take advantage of it. Well, was it 20%? Let's do deductive reasoning. Was the return on the market 20% per year over the last 10, 15 years? Did the S&P return 20%?
Not quite.
Not even close. Did it yield 3%? No. Did it yield 5%? No. Did it yield 8%? Maybe. Did it yield 9%? Probably. Did it yield 10%? Probably. Did it yield 12? Probably not. So through deductive reasoning, you can figure it out. You can just figure it out. So Perry, what did you come up with?
Well, I don't know. It says this right here. It says 2%, but that's obviously not right.
It was between 8 and 10. Okay. So what do you want to use for the expected return on the market? You want to use 9? Okay, so what's 9?
Oh.
9 minus 2.5.
Okay, here.
What does that give us?
Are you saying for the how long? For the past 30, 10 years?
I
or
can
something?
use 10, I can use
10
15.
years it would be
It was
like
7.5.
Okay, so 8%. You want to use 8 or 9 to be conservative? You want to use 8?
Yeah.
Okay. So to get the market risk premium, 8 minus 2.5 gives you 5.5. That's the market risk premium times the beta, 1.57. What does that give you? It's 1.57 times 5.5. It's 8.64 plus 2.5. What is it? So basically 11%. There's your first discount rate. And then the expected return on the market, that's your second discount rate. So did we ever get the debt and equity so we can calculate the weighted average cost of capital? Can somebody find me some yield maturities on Goldman bonds? Maybe 7-year maturity or 10-year maturity? Do we know the capital structure?
According to the balance sheet, total liabilities for 773.
Yeah, take out everything, just go straight to the long-term bonds. And then the equity, owner's equity. Just the long-term bonds.
189,086.
189,086, something like that. Okay, and then what do you get for owner's equity?
$76 billion.
Is that correct? For the value of the owner's equity? Can somebody verify that? You can also get the information on their annual report if you go into their their website into investor relations, you can click on the 2016 audited annual report, and that should give you a good view of the target or optimal capital structure.
This is with bonds.
Yeah, this would be the bonds.
Okay, so the debt is for,
And I don't want short-term liabilities. I just want the medium, longer-term debt. Because that's how they finance their assets. What did you get? If you don't find it, you're gonna have to go back and find it, and then you'll have to calculate the capital structure.
I'm pretty sure the debt is 249 billion.
Okay,
and
that's
then-
pretty close, actually.
And then
Hold on. 249, got it. What do you get for owner's equity?
75.7.
Okay, perfect. Okay, we're in. What, does it make sense? The debt is larger than the equity. You're gonna lever up your ROE, which you wanna have a higher debt. Lever it up. Yep. So it's 249 plus 76. What does that give us? Okay, are you verifying all this?
Mhm.
Okay. And then what's 249 divided by 325? This will give us the weights.
0.766. So it's,
And then
yeah,
this is-
77.
It's gonna give us what? Capital structure. And what did we say earlier in the semester, how most industrial corporations finance their assets? 70-30. 70-30. Okay, we're in. So we know the cost of the equity. Right? Now we need the cost of the debt. So can you find me or guess what you think their average yield to maturity is on their bonds that are maturing between, I'd say, 7 and 10 years, maybe 10 years? What's the current 10-year treasury yield? What's the current 10-year treasury yield? We're forecasting 2.5. So that's gotta be the risk-free rate, right? Goldman can't borrow at the risk-free rate, but it's the risk-free rate. So the question then, what's the risk premium that we tack on to Goldman? Is Goldman conservatively leveraged? Or do they use a lot of debt compared to equity? Yeah, so is there gonna be higher or lower credit risk?
In that equity is in 22, right?
What is it?
Equity is in 22.
So we first come up with the risk-free rate of 2.5. Then you gotta tack on a risk premium for Goldman. So what do you think that would be? Because they can't borrow at the risk-free rate. Just guess, what do you think Goldman's bonds yield to maturity is 11%? Do you think it's 11%? No, because the bonds yield have to be less than the cost of the equity. Okay? And the risk-free rate is 3. So obviously it's got a range between maybe 8 and 3. What's the average between 8 and 3? Like 5%? Yeah, that's probably it. Again, you can get there pretty quickly. So it's probably 5%. So a 250 basis point risk premium on top of the risk-free rate to get to a 5% cost of debt. I'll take it. It's probably right. So what's 0.77 times by 5? What's 0.77 times 5? Again, I'm trying to get the weight of the debt here. What is it? What is it?
3.85.
3.85. And what's 11% times 0.23? It's 11 times 0.23.
2.53.
2.53. So I got the weighted cost of the equity. And what's 3.85 plus 2.53? So we basically, let's round it up, let's be conservative. WACC is 7%. Expected return on the market is 8%. And the CAPM is 11%. Why don't we do it like that? So you came up with a WACC of 7. The expected return on the market was basically between 8 and 10, so let's just use 9. And then you got a CAPM of 11. I actually think this might be a little high here. I think I was, because I only got one beta from everybody. I didn't hear any other betas. So I don't know if this is too high or too low. Where did you get the beta? From their website?
On the BL report,
From which one?
one of the reports you sent us, the BL report.
Okay. Now, this may be a little too high. But let's just go with it. So basically your sensitivity analysis on your discount rates are 7%, 9%, and 11%. I usually like to have the differences by 1 percentage point, but maybe you'll go back and redo it. Okay, so do we know, now we can do the valuation. So do we know what the cash flow is we're gonna use to do the value using the perpetuity model? What cash flow do we use to start the valuation process? Do we use next year's, this year's, or last year's? Next year's. So if we're using next year's earnings per share, what earnings per share do we use? Which one? Yeah. Okay, and let's divide that by 0.07, 0.09, and 0.11. So what value do you get? 21.11 divided by 0.07.
Where'd you get the 2111? Oh, there, yeah, there it is.
Projection?
Yeah.
What is it? Okay, so the first thing I want to do right now is go, what's the current stock price? See if we're even close. What's the current stock price?
224.82.
224.82.
Yeah.
Okay. And what's 301.57 divided by 22.4.82? I want to get the premium. 34. Okay. And then what's 21.11 divided by 0.09? What is it?
234.56.
Okay. And what's the premium on that? How much?
4%.
Is that right? Is that correct? 234.56 divided by 22.4.82. Is that 4%? I need confirmation, so I can't move forward
What?
using wrong numbers. Okay. And then what's 21.11 divided by 0.11?
192 or 191.91.
Okay. And then we know what the cash flow is going to be. 21.11. Right. And we want to do Gordon growth next. We know what the discount rates are. So we're going to have to figure out the growth rates. So what do you want to assume on the growth rates? We're going to do this quickly. I'm not going to do the Gordon growth grid right now. valuations that way. 1 minus 7 is 6, so it's 21.11 divided by 0.06.
351.83.
What is it?
351.83.
And then 7 minus 2, that's 0.05, so it's 21.11 divided by 0.05. Okay, and this is gonna be 0.4, right, 7 minus 3, so it's 21.11 divided by 0.04. Okay, and then it's 21.119 minus 1, which is 0.08. 263.8, okay. And this is 7.
301.57.
1.57. And this is what, 6? 9 minus 3% is 0.06, so 21.11 divided by 0.06. Okay. And then 21.11 divided by 0.1. Okay, 1 minus 11. 11.1. Okay. And then 11 minus 2 is 0.09, so 21.11 divided by 0.09. 6, and then the last one, 11 minus 3 divided by 21.11 gives you what? 263.9. So the question here is, which one do we use? Which discount rate do you want to use? And what growth rate scenario do you want to use? These guys are almost $1 trillion, 900 billion, so there's no way they're going to grow at 3. So the question is, do you think they can grow at 2, 1? Do you want to use return on the market? Do you want to use CAPM? What scenario do you want to use to get the intrinsic value using the Gordon growth?
Say 1.
What?
1.
You want to use 1?
It's safe, yes, right?
So it's going to be 351.8, 263.8, and 211.1. So now we got the sensitivity here. Let's figure this out now. So what discount rate do you want to use? What valuation do you want to use for perpetuity and Gordon growth? Because we're going to need them when we do the sensitivity analysis. You want to use 7, 9, 11. Which one do you want to use?
7.
Okay, so you want to use the WACC? You want to use the CAPM, return on the equity? Okay, anybody else have an opinion? Again, what's going to happen is everybody will make decisions and you will remember a lot of the stuff that's going on. Because you're not
9,
engaged.
actually.
Go ahead. So
I meant to say 9. I wanted a 9 one.
okay, I got 9 and 11. Anybody else? 9, 9, 9, 9, and 9. Okay, so we already got 2. So we already know the cash flows. Now, can you find me some multiples for Goldman Sachs, what the current multiple is, and maybe the peer group also? We know what the cash flow is. It's going to be 2111. Right, we're going to use that. And we're going to use 0.09, right? What's the multiple that we get 1 divided by 0.09? What multiple is that? Can you run the calculation? Somebody calculate? Can you run the calculations for me? What is it?
11.
And then we used what? 1%, so it's 0.08. 0.09 minus 0.01. This is the Gordon what's the, can you find me the multiple for Goldman Sachs currently? Well, we already know the current stock price is, right? What's $224.82 divided by 21.11? We'll just use what we got. Let's see what we come up with. So take the current stock price divided by the 2018 and 2017 to get some multiples. Again, you need to figure out what the multiple is going to be for next year.
10.65.
Okay, so this divided by this.
10.65.
It's 10.7 times. We got 10.7 times, we got 11, 12, almost 13. Okay, did you do it with the 2017? Oh, that's 11. Now, can you find me some multiples? What's the multiple for JP Morgan? What's the multiple for Bank of America and Wells Fargo and Citigroup? You have to do the comparable approach. How are we doing on time?
We're out.
Are we
By
out?
2 minutes or anything.
Can you bring me some multiples? Yeah, so we can do the multiple grid,
Yes.
evaluation, and then do discounted cash flow. These look good, this looks good. Discount rates look good. Again, I would program this stuff. We got a really number after we do the analysis.
Yeah.
Yeah, you can put the deliverables in the box, but you have to take cookies.
It goes memos and then everything else, right?
And cover, memos, midterm, homework, movie review, and resume.
The cover goes.
I think I left my
Cover
movie
goes
review at
first.
home,
Okay.
so should I bring the movie review on Thursday and just add it?
Yeah, because I'm not going to correct them.
Okay.
Or